Good afternoon, Robert. Thank you for joining us on the show.
Thank you, Chimeze. It's my
Now,
pleasure to be here.
yeah, a lot of analysts anticipated a status quo. Did you see that move coming yesterday?
Unfortunately, most analysts expected that there was going to be, the status quo was going to be maintained. Even though it was not public out there, we expected that there was going to be a cut in the NPR. So for me, it wasn't surprising. And to be honest with you, I think the Monetary Policy Committee, is now beginning to toe the line of, what we've always said in that when you look at policy consideration, especially most of the times people tend to think when you have inflationary pressure in the system, then what you should have should be NPL going up. But sometimes it's not that easy in terms of monetary policy management. What the committee has done is the right thing in the sense that the inflationary pressure that you have right now is not induced by monetary condition. This is a cost push inflationary pressure, which the committee alluded to yesterday. And I think for me, the decision was apt, and I will still expect that in the months to come, we will have more rate cuts just to align with market rate, and stimulate growth within the economy, which is the secondary objective of the central bank.
Well, analysts at FDC described the move as a deja vu, like we've been there before. And of course, analysts at Nova Merchant Bank say any policy that focuses on stimulating credit growth alone without a major revamp of the structural bottlenecks in the economy will do little to provide cheaper credit to boost output. And of course, we heard the central bank governor emphasize on the need to address structural supply. What's your take on that?
So what I think is that let's not forget, so when I say the move to reduce the rate is apt, what I'm saying in essence is that there are bottlenecks, there are structural bottlenecks, to be, that also affect, creating credits. You could see from the CBN data, say from May till date, we've seen about 4 trillion naira of credit that has been created in the system. But if you dig down, you will find out that it is possible that the corporates, the large corporates, multinationals, account for the bulk of the credit that have been created. Now, we still have a situation where most SME businesses may still find it difficult to access credit, even if the rates are much lower than they used to be about a year ago. Now, the issues are because the banks need to be comfortable with the kind of credit they want to create. So to that extent, when we say that what the MPC has done is in the right direction, what we are really saying is, think about it. If we do not have this pandemic, facing us, and Nigeria's economy is not heavily dependent on oil, what we should be talking about now is stimulating growth. And look at various economies of the world. Major systemic central banks are focusing on stimulating growth at this time because a lot of jobs have been lost. You've seen a situation where economies are dipping even further than they think they could ever dip. These are situations that calls for, strategic monetary policy action. So, which is why I said what they've done is in order. However, where I think that the central bank needs to watch is in the area of its development financing agenda. Because if you look at one of the comments that was raised yesterday, the central bank has said they will continue to, pursue growth stimulation through its development finance agenda. We need to watch it. One of the things that we need to do is to really, de-risk the environment, more or less, just so that we can still allow the, normal system to help in creating those credit that we need to grow this economy.
Now, how do you see investors reacting to this latest move by the central bank?
Already, some investors anticipated it and positioned ahead of the news. Again, let's not forget that the correlation between NPR and the real investment, so market rate in this instance, is not really as strong anymore, especially because people now track short-term rates, treasury bills, and OMO, and then liquidity in the system to determine the direction of yield. Nonetheless, that court also signaled that from the monetary policy perspective, the central bank and the monetary policy committee is committed, to continue to pursue a downward trend in the yield. So again, most investors now are beginning to realize that, and one of the things we're seeing now is that, which is what the market has suggested anyways, right? Because if you look at the maturity profile of liquidity in the system, it suggested that you're still going to see that downward yield trend, yield trending downward up till the end of the year. So market is already thinking in that direction. What you're likely going to see, are opportunistic investors who will just play the short term. But in terms of general direction of yields, it's a downward trend. Again, this is the time that investors need to, be more cautious in taking their position so that you don't get your fingers burnt.
All right, thank you very much for sharing your thoughts there, Robert. Robert Omotunde is an investment officer with Afrinvest Securities.